Hello, friends. Welcome to Nirmal. I'm Piyush, and today we are bringing to you a corporate conversation, a result review, housing finance. Again, that has been a segment where it is seeing benefits from two perspectives. Number one, we have been seeing a lot of sales, a lot of momentum in the residential markets, and again, if that's the sort of case, then obviously housing finance is one which gets benefit out of it. And second, we have been seeing a lot of stable trends despite rising interest rates. We have been seeing sort of a lot of strength in this market, perhaps maybe because of rising disposable income. What could be other reasons? We will try and understand from our guest today. But what sort of the new news which is emerging out is that perhaps interest rates have almost or have peaked out, and that perhaps could also be news for the sector for FY24. So let's try and understand about the sector, about the earnings of the company we're going to talk about. And for that, now let me welcome the head corporate planning and strategy of Star Housing Finance Limited, Mr. Kalpesh Dave, to the show. Kalpesh, welcome to the show.
Hi Piyush, pleasure. Thank you so much.
So, Kalpesh, I remember the last quarter we talked about the numbers were actually looking quite stellar, quite stable last time. And again, we actually have seen that you've closed the year with very good stable numbers. Loan book has basically has the gross loan book has jumped by more than 100% versus last year. We are looking at NPA numbers which are very stable. The gross numbers are around 1.68%, net NPA around 1.25%. So pretty much stable. We actually are also seeing AUM almost touching 250 crores almost. So a good stable growth. So I'm just coming back to you. Help us understand how the March quarter overall went as per your expectations.
So, Piyush, Q4 for any housing finance company would obviously be a topping in terms of the business performance. But I don't look at it from the Q4 perspective. I would want to see the performance from FY 2023 overall 12 months perspective. So, going back to April 22, we had resolved back then that we will grow. This would be the first year where we will be planning for that kind of a growth. Obviously, the base is small, and hence there is 100% year-on-year which is being seen. But then we had resolved that we will move ahead from this 100 number of the loan book, which is kind of a sticky for us. And the what gave us the confidence also the fact of the matter is that the macros were also getting stabilized. The COVID impact was kind of receding back then, and we thought that given the capacity that we have created, we should utilize it. Our equity and our liability engines were firing, and hence we decided that this year onwards we should scale up. And happy that we have stayed true to the planning that we had done. As you rightly said, that the gross loan book has crossed 250 odd crores. We had resolved that we should be around 200, 225 plus crores. So we kind of crossed that number. Also, that our monthly disbursal rate, basically, which was around 5 to 7 odd crores back then, which has now increased to around 50 to 20 odd crores. So that also has been a step up in terms of the utilization of the capacity of the existing branches, and we also opened several new branches in our existing geographies. We not expanded outside our current operational geography, but within that we have basically kind of doubled our branch count, physical count, and taking the entire branch. I mean, the digital piece in place. We are now present at 30 odd locations across our operational geographies. So that basically, provided a much needed thrust in terms of growing our numbers. So my existing branches are now, operating at a full capacity, and the newer branches are now kind of scaling up in terms of their optimal capacity, and we see the run rate building from here on as well. So now coming to the what enabled this growth. Basically, we raised equity during the year, so we kind of raised around 32 to 35 odd crores of primary equity for the company, courtesy of which our net worth went past 100 crores. So that was the one big milestone from the equity front that we wanted to share with our stakeholders. Second thing, our liability kind of scaled pretty well. So borrowing outstanding also has kind of almost doubled in numbers. So from 78 crores, the borrowing outstanding is 162 crores. During the year, we raised around 115 to 120 odd incremental liability lines from existing and new lenders. We also got onboarded a social impact fund. We also got a private sector bank under our engagement program, and there are other FIs also who have kind of participated in our overall liability scale up. So out and out that firing well gave us that necessary thrust to build a loan book, and happy to have walked the talk, as I said, in terms of numbers. See, what more important, Piyush, is scale up. Scale up is fine. I mean, anyone would scale up given the availability of funding on tap. But what is more important is the scale up should be backed by quality. So our scale up has been systematic. It has been backed by policies, processes, and guidelines. So there is a detailed, framework basically, which one file has to go through out and out from a lead generation to the final disbursement. So there is no deviation on that, and courtesy that our portfolio at risk, the par number, which is 0 plus DPD, that has also come down to now sub 5%. So that also is a very good result to see and share it with our stakeholders. And for the incremental loans basically that we have disbursed, they stay retail in nature. 98% of my book is retail. Incremental loans are retail in nature, and those incremental loans are do not have any NPA. I mean, the PAR for that book is sub 1% for that matter. So yeah, happy. What matters the most is maintaining this particular quality growth, and carrying forward the momentum in 23-24.
Sound interesting. I also would like to know, like, what was the sort of fundraising activity being done in this quarter?
So, 23-24, the fundraising is being planned based on what we want to achieve on the asset front, Piyush. And on the asset front, as I've already said in my management commentary, also with the stakeholders in our earnings call, is that we are looking forward to become a systemically important home finance company, which is 500 crores of AUM. This is what our first milestone is. If we are able to achieve it in 2024, good enough. So that is the first thing that we want to do. And if that is something which we want to plan for, incremental disbursement of around 250 to 300 crores is something which we have to plan. So based on that, incremental liability of around 250 odd crores, incremental fundraise, I would say, of 250 crores is something which we are looking forward to. Bulk of it will obviously come through the term loans and the other diversified liability instruments that we are going to planning to subscribe, planning to bring for our investors. And capital raise plan is also subject to all approvals in place. We look forward to strengthen our capital levels from here on as well. So right now, at this point in time, if you ask me, leverage levels are pretty modest at 1.6 times. So there is not real need for raising capital. But as I've said in my commentary, also in our previous interaction, is that we are looking forward to become a mid-size HFC and then become a full-scale HFC over a period of next 36 to 48 months. So for that, capital raise is something which we are looking forward to, and we should be raising capital subject to all approvals in place at regular intervals for that kind of scale up if we are envisaging.
So, for that, basically, as you were just alluding to, like, what is the sort of amount of equity funds you would be actually looking to raise in FY24?
So again, I'm not giving any guidance as such, but
Okay.
around anywhere from up to from 50 crore onwards is something which you should be looking forward to raise in the current financial year. So
Okay.
again, not sharing any of the projections, but the cap table consists of reputed HNI professionals. There are institutional investors also in place. There are family offices. There is an FPI in place. So there is an interest event. So we have to decide on how we want to go ahead in terms of our capital plan, our capital days. But yeah, one thing is for sure that in this year we should look forward to have another round of capital, again subject to all approvals in place.
Fair enough. Now let's also talk about how's the sort of economic scenario looking to you. We are almost at the end, or almost moving towards the end of interest rate hike cycle. Looks like I was combining two parts: the last RBI commentary, and keeping in mind in the last 17, 18 years, we have not seen that when RBI completes its interest rate hike cycle, takes a pause, then RBI actually comes back and does another rate hike. So if I keep the 17, 18-year trend intact, it appears to me that this pause perhaps could be indicating that we have actually reached the top here. inflation is now below or at the target what RBI wanted. And number three, actually, bond yields actually has started dropping. So bonds are rallying now. So perhaps if I combine the story, it appears to me that the rate cycle is now actually is peaking out. What it implies for a housing finance company like yours, and what we should really expect as an impact on anything which is earnings growth or cost of funds, like what it means for you.
So yeah, it's a very good and a pertinent question, Piyush, for a housing finance company like us. So the repo rate hike cycle, which we had seen, has kind of impacted us in terms of our borrowing cost getting increased, because it's a very natural thing for lenders to pass on their rate hikes onto us, or onto, for that matter, any of the creditors, be it retail or institutional in nature. So definitely our cost of fund at that point, in that particular cycle has increased by around 60 to 75 basis points. Impact of that was seen in the on the balance sheet in the current year's P&L. However, what offsetted this increase in the borrowing cost was the scale. So whatever scale up that we did in terms of our incremental disbursements, just to tell you, we disbursed around 186 crores in the FY 2023. So that scale up more kind of offsetted the overall increase in the borrowing cost. So again, it's a story for any growing HFC, that if you have a scale, the borrowing cost increase can be that shock can be absorbed into the onto the balance sheet. Same was the case with us. So our loan book kind of grew at around 136, 140 odd percent. Our total income grew by around 92 odd percent. Again, so that is kind of offsetting that has happened for us. But yeah, if it was in a decreasing repo rate cycle, obviously the numbers would have been a bit more than what we have given. So like any other borrower, we also are impacted by
Having
the rate.
having said that, just want to jump in with a question for our viewers, just to remind them, the average category of the loan or the housing loan you would be looking at would be the affordable housing, right? 20 lakhs, 25 lakhs, 30 lakhs, around 35, between 20 35.
So see, again, it's a very broad category when you're talking about affordable housing. So affordable housing can be defined from the property type, from the area of the property, from the customer type. It is quite possible that like a person like you or me would want to buy a house closer to your native area. So if you are buying a house in that particular, though it is an affordable housing segment, the loan that is offered is would be to a prime customer. So, what is a typical affordable housing? I'll tell you, it is not just related to property, also, Piyush, but it is also related to the customer. Typically, this customer would be a first time home buyer, new to credit, buying or constructing own home in a semi urban or a rural geography. So this would be, if these criterias are getting satisfied, that point of then you can say that it is a truly PSL loan in affordable housing segment, and the finance is also provided in the affordable housing finance space. So for that particular customer segment, again, within that there would be a salaried customer, there would be a self-employed customer. So there is a range of interest rate that a particular financial would offer. So it would range from around 11.5, 12% to even up to 17, 18 odd percent. So it all depends on what kind of customer profile that you are serving, what is the history of the customer, and how prone he is to the vagaries of the income fluctuations that would happen given the kind of background that he would be having. So however, if you're talking about us, from Star Housing Finance perspective, our average lending rate is at around 15 odd percent, which means that we are lending at from 14 to 16 odd percent with an average rate of 15 odd percent is something which we are right now having. Our cost of borrowing, to tell you, Piyush, is at around 10.8, 10.9 odd percent. That 70-75% rate increase basically has translated to incremental borrowing cost. So we continue to have around 450 basis points of incremental spread on our that gets translated onto the pre-tax levels. So that is our business functioning. Before that, as I said, that not taking into account 75 basis points of hike that we have had, we would have been at around 550 basis points of incremental spread, which means that this result would have been around 15 to 18% more in terms of overall scheme of things if the rate hike was not. So that's that.
And
If I answer the question.
I wanted to ask one quick question here, and that would be, suppose basically the rates either they go down or the rates are same as per the repo rates, but if we actually see a gradual moderation in the short-term tenor rates, which is the corporate bond rates or the short-term tenor rates, because those are the ones which actually are showing some softness here. Is that
Mhm.
something which can really help you in the second, third quarter, like at least any few basis points will largely help you on the spreads?
No, I don't think so. See, my experience in this space has been like this. Even if there is a softening of interest rates, that hiked interest rate will not get revert back, so soon in the immediate future. So this is going to stay put for 23 24, and we are taking into account this as our borrowing cost incrementally for 23 24, and it never happens because any rate hike is sticky. Even any decrease in rate is not that sticky. I mean, they would again revert it back to their original one as soon as possible. But as I said to you, that this will be our borrowing cost in terms of our annual operating plan that we are preparing for the team that is slated to meet in the first week of May for preparing the overall blueprint. So that would be the borrowing cost. We continue to incorporate this in our operating plan, and any accrual that would come from the saving part of it, that would be onto the PNL. So I'm not seeing anything, any lowering of the interest rate for our existing term loan facility. Yeah, for incremental it might be the case, but for the existing ones, I don't think so. So just to answer to your questions. But yeah,
Sure.
I'll tell you how we would want to diversify it, Piyush. So there is public sector bank, there are private sector banks where the proposals are in pipeline. There are FIs, and there is the refinance lines from the NHB also. They do their own due diligence and offer the credit line to us. So blend of all these facilities should give us an opportunity to optimize in this particular environment.
Absolutely. Makes sense. My last question to you would be from your own perspective of how you're looking at FY24 growth. I'm not asking you to give us guidance or give guidance to our viewers, but what I'm just trying to sort of explore that we know how FY23 has already gone. The results are in front of us. FY24, how are you looking from the perspective of your NIMs? Are they going to be same? From your NII, again, net interest income, that growth, profitable growth, how actually you're looking? Are you looking to maintain the trend?
So yeah, so coming, I mean, to the basic unit of measurement, that would be my average monthly run rate. I'm not going up to the branch level or up to the productivity level of my relationship officer. But if you're talking about the number of branches, as I said, that my steady state run rate is right now in between 15 to 20 odd crores. So that is what I am disbursing right now on a steady state basis. If I'm just multiplying this into 12, then in that case an average of 18 into 12 would be around 216 would be the number for my branch network. So that is something which is achievable. But as I said, that our aim is to become a systemically important HFC. That 500 crores mark is very important for us for the reason that there are several value enablers for star housing. So first thing first is that our net worth, as I said, has crossed 100 crores. So basically the quantum criteria for getting transition to NSE, subject to again approvals in place, that gets tick mark. We are waiting for the tenor criteria. It's a 3 years of net worth, consistent net worth of 75 crores that has to cross. So that gets kind of makes the company ready towards that transition. Again, approvals in place. So that is the first thing. Second is the upgrade in the rating of the company. So our outlook has been upgraded to from stable to positive. So the next step is get that much needed single notch or even a double notch upgrade if the credit rating agency see us getting being deserved for that particular upgrade. So that's the second thing. And the third is the 500 crores even, because then financing perspective, there are a lot many opportunities that kind of open up. So there are a lot of social impact funds, international social impact funds, who are looking at us, engaging with us. But it's only that that critical mass, once it gets crossed, we kind of get qualified under that guidelines or criteria that they have set for themselves. So there are these things we have to achieve. And we do feel that 23 24, again, if we plan for 100 plus year on year growth, we should be able to achieve it given the capacity is already there. So that is what something which we are looking forward to. We should continue to expand. We should add a couple of newer geographies in the current financial year. maybe one geography in the north and a couple of geographies in the south. Our points of presence should again see 100% year on year growth if you're planning in that particular way and fashion. And obviously, domain is something which you're looking forward to. We are open to engage with reputed HFC professionals to partner in this particular growth journey, and that's how the staff also will get built up. So yeah, it would not be incorrect to assume that 23-24 also we can plan for 100 plus year on year growth.
That sounds interesting, and I think our viewers will definitely sort of hear that with a lot of interest. The momentum looks good. The market remains quite vibrant, and we have seen over the last 2 years, financial markets are really doing well. So all of that bodes well for your company. Kalpeshi, as always, thanks a lot for coming on the show, like last quarter, and we look forward towards again interacting with you after the first quarter results. Also, we wish you all the very best.
Pleasure is all mine, Piyush. Thank you so much. Keep tracking us. Keep wishing us well. Thank you.
Absolutely. And dear viewers, that was Star Housing Finance Management. The results were fantastic, 100% plus growth versus last year. And we again will keep a close watch on this. Hope you enjoyed the show. Thank you for watching us.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.